$71,000. That's how much money I was able to make in one singular trade. Not only was it a perfect sayonara to both the month of March and also the first quarter of 2025, but it happens to be my single largest gain of the entire calendar year. And in this video, I'll be breaking the entire trade down. In roughly 2 to 3 trading sessions, I was able to turn $33,000 into $104,000 for the net gain of $71,000, aka a return of over 200%. But more important than that, I want to share with all of you everything I saw going on in the market that told me to get into the trade, and then everything I saw going on in the market telling me to get out of the trade. But before we get into all of those details, I want to hear from you in a comment below. Do you enjoy these types of videos, these trade breakdown videos where I share not only the success or failure of the trade, but majorly what I saw, the metrics that told me, okay, am I on the right side of things or on the wrong side of things? Obviously, my goal is to make content that you guys all find valuable, so let me know what you're looking for in a comment below. And with that being said, let's rock. I think the best way for us to get rocking is for me to give you the overall TLDR of what this trade was. I was trading the Nasdaq 100. I'm not talking about the ETF, QQQ. I'm talking about the real McCoy, the actual index, ticker symbol NDX. And what I did was basically here on Thursday, March the 27th, I bought puts, which is a bearish position. I unloaded half the position at market close on Friday the 28th, and then I got the other half of the position at market open on Monday. So that's the major thing. This was a bearish trade on the Nasdaq, but to understand why I got in this trade, it actually all started with the S&P 500. And let me rewind to kind of what happened on Tuesday. We gapped up on Monday. We failed to push on Tuesday. I thought that was interesting, but I thought, if anything, not really that quality of a trade at this moment in time. And then came Wednesday, where I was like, oh, that's a little bit of a topping formation. We have these 3 candles here where the middle candle clearly has a higher high and a higher low, maybe a potential turn. And I'm also now, my attention is being brought to this downside gap fill around 5,670, 71, roughly in there. So that's the setup. I said, maybe we're topping, and I see this downside gap fill, and you're going to see a pretty similar setup was there on NDX as well. Gap up, a push, a failed push, and then this downside gap fill. That was my mindset coming into Thursday, but the reason why I didn't take a bearish trade as soon as we were breaking this low, it all comes back to the option chain. At that point in the short term, the option structure was still overall dominated by puts, i.e. the bears, but in the short term, it was kind of switching. On certain 0DTs, it was actually ending up being call dominated, so I really didn't want to place a trade that was going against the current option sentiment. And then that's what brings us to Thursday, and really I truly was just looking at the S&P 500 first. Midday on Thursday, I noticed something interesting was going on. Not only did we once again break the previous day's low, but throughout the trading session, especially midday, you can see that the options market was really just getting hit. What you're looking at right now is called spot gamma. The white line is the price action of the S&P 500, and then the purple and the green are just the different delta movements. The green is the 0 DTE, while the purple/red is all expirations put together. But if I were to show you just up until about midday, you're going to say, yeah, lower highs, lower lows. And if you really want to look at it, you're going to see that people were aggressively once again getting back into puts. That's what it means when these blue lines are dropping. People were aggressively dropping the put delta as in aggressively getting into puts. So when I saw that, I thought, okay, maybe this is the time to try to take the move to the downside gap fill. Okay, but then this is all on SPX and my trade was on NDX. So why did I do that? Well, it's because on a relative basis, I know that NDX is weaker and these things are highly correlated. It is very rare for SPX and NDX to diverge in any meaningful way. So I thought, okay, if my overall idea is that the overall market's going to drop, and I know NDX correlated, but right now in real time, it was on a relative basis a bit weaker. Well, I thought there might be more money to be made there. So basically, I was seeing a setup in the S&P 500 and I chose to execute it when I saw what was going on, the fact that just really the Nasdaq was a bit weaker. So anyway, midday, I see all these puts getting purchased, and then all of a sudden, I'm seeing the situation where price action is weak and options went from being a little bit bullish in the short term to back to being bearish. And I figured that's exactly the time that I need to trade. So that's what I did. And I decided to pull the proverbial trigger right around 1250 on Thursday, right here, just because I saw this failed pump, lower highs, lower lows, and still in the back of my mind, I think, okay, SPX still has that downside gap fill. So I took the trade roughly around 1250. 1250. I could show you it here. NDX, I happen to have two puts, a strike price of 19,500, expiration date April 4th, and each one cost me about $169 for a total cost of just below $34,000. At this point, things started to get a little bit weird. Not only did we have a little bit of a rally, and then right at the end of the day, we pretty much had a puke, but you might be thinking, why didn't you take your money there? The whole setup was strange, and I can show you my exact reasoning. It was this little nuance. The gap fill was at 5,670.84. If you look at the low on this day, we didn't get the gap fill, 5,700.94. So this gap was not filled. So I figured, hey, you might as well swing it for the next day. It's rare to get that close without getting the fill. Give it another action, and maybe you get lucky with the trend line breakdown. And as you could tell, that's exactly what happened. So here was the setup on Friday. This is what the overall option structure looked like. You can see there's quite a bit of red. That's a lot of negative gamma, as in if you get going in one direction, you can really get going in one direction. And this is the exact scenario we had when the market was opening right at 9:30. And as you can see, as this progresses, we get sucked right into this positive gamma node, pretty much acting as a magnet throughout the day. And I thought, okay, that's awesome. Like, this was a magnet. You can just see as I was dragging it across, we were really going through this slippery price action of the negative gamma, got caught up in the sticky price action of the positive gamma, literally just playing the major open interest levels. And I thought, man, you're already up enough. Maybe don't take the entire risk of swinging it over the weekend. So I decided to lock in one. You can see right here, right at the end of the day, 354, I locked in one at 407.69, which was a return on that one contract. Remember, I had two, so I closed out one, decided to swing one, and this one was just below $41,000. So close out half the position, and at that point, I paid for the entire cost of this. So no matter what, I was kind of playing with a lottery ticket. A fair question at this point is, why did you decide to swing half over the weekend? And once again, it comes back to studying what in the world is going on in the options market. I knew on Monday, March the 31st, JP Morgan had a giant put position that was somewhat close that needed to expire. You can see it once again, shout out to Spot Gamma, this position right here. 37,000 contracts on SPX at 5565, which was considerably far away where we had to be. We closed out at 5582, as in there was potentially another 20-point difference that I could take advantage of. So at the close of the day, that's what I was thinking. I knew that JP Morgan had that position that the market most likely wanted to test, and it was still there. There was some negative gamma, and I figured, yes, it was worth the risk to swing at least one over the weekend, and that's exactly what I did. So here we are, very quickly moving forward. I got into the position on Thursday. There was the breakdown on Friday. I closed one out at the end of the day, and then swung one to the very next market session, which happened to be over the weekend on Monday. And the thesis was pretty much exactly this. I know that the market most likely wants to test JP Morgan. We obviously opened up below it, and I figured, man, that is a good time to lock in because it was really a bonus play for me. So that's exactly what I did. When the market opened around 9:52, I gave it about 20 minutes to see if there was an additional capitulation, but in reality, I saw the market starting to pick back up, and I thought, you better get out while the getting is good, and I got out of this one at 640.79, a gain of 64, and that's the exact math. 64 plus this 41, that's the 104. It cost me 33. So that's exactly how I got that net gain of 71. And if you do the percentage on it, that's the roughly just over 200% return. So to quickly review, I thought it was interesting how on Wednesday, the market started to show some weakness with respect to the overall market S&P 500. Then I thought on Thursday, I'll take the trade, but I need to see weakness starting to arise, bearishness starting to arise in the options market. And I saw that midday. And then at that point, I know that there was a high correlation between SPX and NDX. NDX was relatively a bit weaker. So I figured if you're going to be bearish, you might as well play the one that is weaker, which is exactly why I executed the trade. I went long two different puts midday on Thursday. And the fact that we didn't get the downside gap fill, I figured, okay, the market, I know that the odds are high of the gap fill, you might as well swing it. And not only did we get the downside gap fill, but we puked into close. And I figured, okay, good risk management to lock in one and swing one. I swung the second one because the options market was still weak. The options flow was still weak. And I knew about the JP Morgan position. So I thought there was more distance to go. And then to my nice surprise, when I woke up on Monday, we gapped down even further than I anticipated. I gave it a shot to try to puke, but it really actually ended up showing a bit of strength right at market open. So I closed the second one about 20 minutes into the trading day. So in this somewhat regimented system, I was looking at not only price action, I was looking at price momentum, and I was also looking at options. As soon as those three things aligned, I knew to get into the trade. And with respect to managing it when I was getting out, well, I didn't want to be greedy, so I wanted to pay for it. And then I had a lottery position, so I dumped half and I was carrying the other half. But the reasoning for carrying the second half was because I knew what was going on in the option structure, and there was a big position that had to be managed, and it most likely was going to favor the bears because it was 37,000 put contracts, all negative gamma, so the odds were more favorable for a bearish continuation. But I'll be honest, the gap down was way larger than I anticipated, and like I said before, when the getting is good, you might as well grab it. I know there are many traders out there who exclusively look at price action, aka technicals. Maybe they put in some indicators. There's other people who only look at options. And I would argue to all of you, it's when you marry those two concepts, when you look at price structure, price momentum, and options flow, and you see those three things aligning, that is when it's a perfect opportunity where if you can identify a low risk entry, you might have a white whale on the other end of that line. I hope that all makes sense. If anything I said is confusing, if you have any questions, comments, concerns, let me know in a comment below. I'll do my best to get back to all of you. I do appreciate your time. I do appreciate the vibes. I'll catch you in the next one. Peace.